The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Tuesday, everybody. Welcome to my favorite business show. It is called Squawk Box with Carolyn Roth and myself, Steve Sedgwick, and Sylvia Morrow in the wonderful Siena, one of the great towns of the world. Now, these are your headlines. Tuesday turnaround. Markets in Asia rebound from an 18-month low, whilst on Wall Street, investors, well, hoping the worst has passed, with futures pointing higher after a wild session. The Nikkei also jumping after Japan is granted priority US trade talks, with Tokyo dispatching its top negotiating team en route to Washington as we speak.
Beijing slams what it calls U.S., quote, blackmail and vows to, quote, fight to the end after President Trump threatens to double tariffs on China this week.
I have a great relationship with President Xi. I hope it's going to stay that way. I have great respect for China, but they can't do this. We're going to have one shot at this, and no other president's going to do this.
The EU says a 040 tariff deal is on the table for the U.S., but it also prepares its own retaliatory measures. The CEO of Monte Paschi tells me that Europe can see out tariff turmoil.
Inflation will rise, corporate earnings will decrease, and there will be problem for all consumers around the world. Being part of Europe, I believe that Europe has everything is needed in order to weather the storm.
Right, good morning. Good morning. How are you?
Good.
Let me start off by saying congratulations, all of you. Like, you're still there. You're hanging on in. What a ride.
What a ride.
What a ride. I know you're going to come up with a lot of these stats in the moment, but and the absolute levels are extraordinary. But let me just add a couple more. The Dow yesterday had a 2,600 point, 2,595 point swing from low to high, and then came off again after that. The volume figures.
28.9 billion
28
shares traded.
Well, let's put that in context. That's a record ever.
That's a record, and the second record in a row. So 2 days in a row with record trading volumes. So this has got to be good for someone, the equity trading desk, obviously. Not for everyone.
If you own volatility, which
Right.
is an asset class which is underappreciated, very, very difficult to trade very often as well. If you've been trading what's called your gamma, i.e. when the market moves, you create a delta, which is in, if you're long premium, you've got a position at the bottom where you can afford to buy because the gamma's creates a short position, and at the top where you can afford to sell. So if you own premium, you're probably making hay. The problem is when the volatility comes off again, you lose what's called your vega, getting a bit technical here.
That's fine.
So you've got to be a little bit careful when the VIX turns as well. But it's great while the market's still moving aggressively.
The VIX ending at 46, that was the highest close in 5 years.
Talk us through the futures, because I think
that's really fascinating.
It is fascinating. I mean, the futures now, what are we at? We're hours and hours and hours out before the start of US session, so it's very early doors, but here we go.
The S&P is seen higher to the tune of 1.2%. The Dow Jones seen up at 1.5%, and the NASDAQ seen bouncing by 1%. And Steve, I'll send this back to you. Is this more than a dead cat bounce? Is it buying with conviction? I don't think so. Nothing materially has changed, has it?
I think something materially has changed, actually.
What is it?
I think that, do you know what I really think? I think the money in the United States, the power brokers in the Republican Party, the power brokers on Wall Street, and the billionaires are getting fed up. And when the billionaires, the people who back Trump, who he relies on for funding, when they are saying that there's problems here, and we're talking from Musk to Ackman to Druckenmiller to Langone and others, then I think you've got to stand and think, hang on a second, is there a problem here as well? And as such, Trump, I know he's talking about the 50% extra, and then the market moved aggressively on the 90-day pause story, which was apparently fake news, and apparently it was fake news. The fact of the matter is, if the money behind the administration is getting fed up with the aggression here, then I think then there could potentially be more rapprochement in those talks. And as we're going to speak to Carrie and Joji, who is a brilliant correspondent and colleague of ours, she'll tell you about the Japanese story in a minute.
I'm a little skeptical here. You think that some of these big names have put a floor in the market? Well, there's no Trump
put a floor on the aggression of the policy, and way before the market can find. Don't get me wrong. There's other things going to happen now that Trump has unleashed. He's unleashed a lack of investment, a lack of confidence, potentially companies shuttering jobs down and factories and what have you. So I think in terms of the volatility on the headline of the aggression of the tariffs, I think we're at the beginning of the end or the end of the beginning. But I think that what he's unleashed could last years.
And we'll talk to Paul Donovan from UBS Wealth Management about this in just a few minutes. But again, there's no Trump put, there's no Fed put. So what really fundamentally, sustainably is going to calm this market? That's my big question. Let's take a quick look at Asian markets as well, because that's where we're seeing some technical rebound as well. Asian equities higher across the board. The Nikkei 2 to 5 up by 5.4%. We'll get out to Kaori in just a few minutes here on those very important trade talks. The Hang Seng, which saw its biggest decline since the Asian financial crisis in yesterday's trading session, is bouncing back to the tune of 1.3%. European futures looking green as well. Let's take a look at these. The Stoxx 50 seen up by 1.8%. The FTSE 100, which was down by more than 4.5% yesterday, seen up by almost 1.8%. And the Xetra DAX, which of course bore the brunt of the losses, with some of the defense names coming under a lot of pressure, seen up by 1.7%. Just want to let you know, these European markets closing at 14-month lows yesterday. The volatility at a 3-year high. Treasuries, this was a really interesting one, Steve, because we saw the biggest sell-off in 2 years yesterday. I think the 2-year up and the 10-year yield up by 16, 17 basis points. Huge moves here. A couple of explanations, potentially. Maybe the market getting worried about inflation down the track. Maybe they don't know how many times the Fed can cut, or you have a very simple one.
I do, yeah. You sell what you can in this situation to cover your leverage losses, your margin losses. I mentioned about the options market earlier on as well, and your Vegas and your Gammas. Very often people trade on margin on their stock purchases, and when the move, you have initial margin, variation margin. Initial is what you put down originally. When the market goes against you, you have to top it up with variation margin as well. And I think it's very simple here. Gold and some of the other safe havens, such as the bond market, they suffered because people had to find money from somewhere to either take the losses and close out the losses on their stock positions, or indeed actually top up their margin.
And that is not a sign of confidence. That is a sign of, hey, panic, I need my liquidity.
Yeah. Beijing has vowed to fight against Washington's tariffs, quote, to the end, with the Chinese Commerce Ministry saying it would not accept what it described as blackmail by the United States. This after US President Donald Trump threatened to impose an additional 50% levy on imports from China from Wednesday in response to Beijing's retaliatory 34% tariffs announced late on Friday. That would take US tariffs on China to 104%. Speaking on Monday, Trump said he was not looking to pause tariff, but is open, okay, here we go, but is open to talks with trading partners, including China.
I have a great relationship with President Xi. I hope it's going to stay that way. I have great respect for China, but they can't do this with just, we're going to have one shot at this, and no other president's going to do this, what I'm doing. And I'll tell you what, it's an honor to do it, because we have been just destroyed, what they've done to our system. You know, we have $36 trillion of debt for a reason. And the reason is that people allowed it to get that way. So we'll be talking to China. We'll be talking to a lot of different countries. And I think, you know, if we can make a really fair deal and a good deal for the United States, not a good deal for others. This is America first. It's now America first.
As we mentioned before, President Trump says Japan is sending a team to negotiate on trade. In a post on his Truth Social account, Trump said, quote, tough but fair parameters were being set for talks, accusing Japan of treating the U.S. poorly. Meanwhile, U.S. Treasury Secretary Scott Bessent told Fox Business that Japan would likely have priority in holding talks because it came forward quickly to negotiate. Let's get more analysis and context on this with Kaori, who joins us live from Tokyo on this story. Some very difficult talks ahead, Kaori.
Carolyn, if first mover advantage meant something, then Japan would be in the front row because the U.S. trade representative will be meeting with a gentleman, the economic fiscal policy minister here, Akazawa-san, who local public television showed at the airport en route to Washington, D.C. So all this time in the last 4 days over the weekend and continuing on today, we had a war of words, people shouting back at the U.S., so to speak. But the Japanese side has kept its head down, and that seems to have been paying off for the time being because the Prime Minister Shigeru Ishiba got that coveted telephone call with Donald Trump last night, 25 minutes. Here's what he had to say after that call.
I told the president that Japan has been the world's largest investor in the US for 5 consecutive years, and I also strongly expressed concern that the US tariffs will reduce the investment capacity of Japanese companies.
This is full court press from the Japanese side. It's moving like clockwork this morning because everyone who's anyone in Japanese government got together at 8 a.m. and huddled on a strategy. An hour later, the finance minister came out and said, look, I'm going to talk to my the counterpart, the U.S. Treasury Secretary. And mind you, a lot of economists are saying, look, the strength of the yen could be on the cards. A little bit after that, the chief cabinet secretary here in Japan came out and said, look, we've appointed this gentleman to go talk to the USTR. So there he is en route. But of course, this is early days in a very volatile situation. Guys?
Corey, obviously, Donald Trump, the president of the U.S., has some sort of affinity to Japan. Now, what does that mean, again, for the very complicated talks when it pertains to the auto industry and also, as you mentioned, on the strength or the current weakness of the yen?
Well, I mean, back in the 80s, there was a trade war between the U.S. and Japan. I think Japan remembers that very, very well because it cost them dearly. And we know that Donald Trump remembers that era, in the 80s as well. And back then, Japan conceded by doing something called VERs. Those are voluntary export restrictions. So Japanese exporters, car companies basically said, look, we're going to restrict the amount of exports because you don't like the fact that Toyotas and the like are killing the U.S. competitors. That could be something on the cards, but remember, I think this is going to be an all-Japan comprehensive package, not just the Japanese government. So remember, in an economic crisis like this, Toyota, the buck stops there. Not only are they the biggest automaker, they employ thousands of people down the food chain, suppliers basically, and small and medium-sized enterprises make up for 70% of employment here in Japan. This is why this is a crisis. So there are call centers being set up all across Japan and in Tokyo. The phones are ringing off the hook because these small and medium-sized enterprises want to know what the heck is going on. But I think there are a lot of other things that could happen this time that didn't happen way back then. For example, we know Donald Trump is not a believer in climate change. We also know that the Japanese are very energy inefficient. They're not self-sufficient in energy. So they've been buying a lot of LNG. There could be a deal struck on that front as well. I mean, there could be other ideas tabled, fresh investment from Japanese corporations. But I think the whole tariffs on Vietnam, I think that's a whole new ball game that Japan was not ready for, and they are shell-shocked.
Corey, thank you so much for that. So much at stake. Now, as fears of an economic downturn rise, BlackRock CEO Larry Fink said many business leaders believe the U.S. is already in a recession. Throughout yesterday, several industry leaders weighed in, giving their take on the fallout from Trump's tariff policies.
It's very clear to me that the president has decided the best way to get inflation and interest rates down is to take a recession. And, recessions tend to have certain recurring patterns to it. And I think we're heading to a recession.
I would not be surprised to see elevated inflation over the next 5 months. I would not be surprised to see, and across every CEO I talk to, we're starting to talk about a more fearful economy going on right now. And a lot of it is that fear. But I do believe this is going to be more short term. Once we understand the policies, once we become more accustomed to it.
We have a lot of dry powder, and I talked about cash as a recommendation on Fed days for the past few Fed days, as much as 25 or 30% cash. I would not be deploying that cash yet. I think you're kind of in the middle innings of this thing, although certainly the market going down so much on Thursday and Friday, it's a little bit disconcerting that we don't have more of a bounce in the market.
Now, there are certain people I trust and I would turn to every single time for advice in this situation. And one of those, for all of our ribbing over the years, is Paul Donovan, who is Chief Economist at UBS GWM. Paul, I genuinely am fascinated in what your helicopter view is of this as well, because you've seen it all before as well. What do you think of what we're seeing?
Well, I think with regards to recession risks, those have clearly risen. There's no question about that. You've got a massive tax increase. You've got massive disruption and uncertainty coming through. Obviously, that's gone up. However, we do have to remember just how strong the economic foundation was at the start of this year. What is happening now is very destructive, but it's very destructive from a strong starting point. And that means that I think if we continue with the current policies, if the taxes on US consumers stay at these levels, a recession will happen in the United States. Maybe not globally, but in the United States. But if we were to see a rapid retreat, and President Trump has retreated very rapidly on earlier tax increases, then I think you might get a downturn. There's no question the US is slowing into a weak economic situation, but you might actually avoid an outright recession.
Do you believe, and I say this because I know you've just done a piece, I think the headline was Competence Matters. Do you believe that this administration is economically incompetent?
I think the problem that we have with the administration at the moment is essentially two things, and yesterday's market moves really demonstrate this. The first is that policy is very erratic. There's no certainty about policy. We saw with the taxes on Colombian imports, they were imposed, and then hours later there's a full-blown retreat, and they're all off the agenda again. So that sort of thing creates this natural level of uncertainty. And then the US system of government is now tending towards the imperial. It all depends on the views of one individual. And that means that only Trump can deny fake news rumors. And if there are credible rumors about what he might be thinking, the market will go off in a certain direction. Now, what's the problem with that? Well, one of the key problems with that is that whilst this creates volatility in financial markets, this level of uncertainty creates serious questions about longer-term investment. Do you want to build a factory in the United States if you have an erratic policy dependent on the whims of one individual? You don't have the certainty to make perhaps what is a 20, 25-year commitment. That could be a problem as we look ahead.
Paul, this is Carolyn. Always great to talk to you. Thank you so much for your time. Now, there's one school of thought that says China is the biggest beneficiary in all of this because all of a sudden China is the reliable trading partner, let's say, for the EU, of course. I know there's always the issue of, excessive dumping and exporting overcapacity, but China seems to be the better trading partner going forward. And there's no longer decoupling, but recoupling. What's your view on this?
Well, China certainly, I think, is in a position to take advantage of this, as is the EU and the UK and so on, because what we have, and I think this is important, this is not the 1930s. The 1930s, the famous 1930 Smoot-Hawley Tariff Act, started a global trade war. We don't have a global trade war. We have the US cutting off its own arm. This is an entirely US-focused situation. So the rest of the world can carry on trading. But of course, we have a big difference between China and the United States when we're talking about trading partners. That the United States has been a consumer, it's been raising its standard of living by consuming low-cost imported goods, whereas China is a producer. It runs a trade surplus. So for Europe, yes, China may be a more dependable trading partner, but it's a very different trading partner when it comes to the interactions because China is a producer, not a consumer.
So if I understand you correctly, Paul, you're saying globalization is still alive and well. It's just the U.S. has basically chosen to opt out of it. So it's a globalized world minus the U.S.?
I wouldn't exactly say globalization is alive and well. Globalization is alive and clinging on is probably the best way of putting it. Yes, I think that you could get to a situation where the United States does essentially become more isolated from the global trading system. EU President van der Leyen was suggesting this when they were saying, well, we'll focus on the 83% of trade that we do that is not with the United States as we go forward. I mean, you can cut the United States out entirely. We're not going down to that sort of North Korean citadel type extreme, but I think that you will see possibly a degree of separation and the United States being a less integral part of supply chains. We have to remember, though, that the process of localization, that is to say, technology allowing the efficient productions of goods close to customers, that's been going on for some time. That's continuing, and that is also going to be reducing global trade as a share of global GDP. But that's an efficient way of doing that, whereas trade protection and economic nationalism, of course, is very destructive.
Paul, another economist who I really love speaking to, yes, I do like speaking to economists deep down, is Richard Koo of Nomura as well. And I know you're probably a big fan of his work as well. And he had a conversation with me actually this time last year where he said, look, the deep imbalances in trade the US has with the rest of the world has fueled all kinds of issues, including, of course, the rise of Trump. And actually, there is a flaw in when you get to these extremes in free trade, although by and large, free trade benefits the world as a whole. Do you have sympathy with the view that actually something does need to change and the US was right to try and change the architecture, even if they've gone into this in the wrong kind of fashion?
I'm a lot more skeptical. I think there are very specific cases where you have imbalances or unfair patterns of trade. But frankly, over time, the pattern of trade was going to move back to favor the United States. Again, it's this localization argument. The United States is never going to create large numbers of jobs manufacturing iPhones because the cost of an iPhone would be astronomical. You can't afford to produce iPhones in the United States because the labor costs are too high. So what could you do? Well, over time, you might be able to increase the automation of the iPhone manufacturing process and have that locate into the United States. But that doesn't create waves of jobs in the manufacturing sector. It is, generally speaking, a sign of economic development that the share of manufacturing jobs in the economy is slowly going down because what you are doing is you're automating away routine tasks and creating new jobs in more intellectually demanding areas of the economy. So the development suggests that you should be seeing declining manufacturing employment. What Trump, I think, is trying to do is sort of hold back the tide of natural economic progress, and I'm not convinced it's going to work.
We'll leave it there. Lovely to see you, sir. And when you're back from your travels, it'd be nice to see you in person, my friend. Thank you very much indeed for your wisdom this morning. Paul Donovan, Chief Economist at UBS GWM. Thank you, sir.
And still coming up on the show, the EU looks to begin tariff talks with the U.S. while revealing the first details of its retaliation plans. Plus, President Trump meets Israeli Prime Minister Netanyahu in the White House with Gaza, Iran, and trade on the agenda. And we'll bring you Monte dei Paschi CEO Luigi Lovaglio's comments on banking consolidation and trade tension. Sylvia is live in Siena after this short break. The EU has proposed a 0-for-0 tariff deal with the U.S., but has struck back with 25% tariffs on some imports. The bloc, which faces tariffs of between 20 and 25%, proposed its first retaliatory tariffs of 25% on a range of U.S. imports. However, the initial list was slimmed down after Donald Trump threatened a counter tariff of 200% on alcoholic drinks from the EU. EU Trade Chief Maros Sefcovic said the EU is ready to consider all retaliatory options, but that the bloc wants to prioritize negotiations. That's a very delicate balancing act for the EU. Sylvia, chime in on this.
Good morning, guys. So no doubt that we're monitoring what the EU is saying when it comes to trade. On the one hand, they are preparing the retaliation measures as a response of the first round of measures that the United States imposed on European steel and aluminium. But at the same time, they are now discussing what other tariffs, what other countermeasures they can put in place as a result of the latest round of tariffs from the United States, what Donald Trump, the President of the United States, called the retaliation measures of 20%. So I know there's a lot of talk about tariffs and a lot of discussions around countermeasures, but it's important to keep in mind that there are several negotiations and several discussions taking place at this stage. Let's see what the EU member states will vote on. There's a vote on Wednesday to exactly discuss some of these countermeasures. But in the meantime, we have to take stock of what is already happening on the European economy. We have seen a lot of pressure on European equities, and that has also been the case for European banking. So I want to take a moment to tell you where we are this morning in the beautiful city of Siena. We are just outside the headquarters of the world's oldest bank, Monte, the Paschi, the Siena. And we know, we've reported many times on the history of this bank. We know it has not been linear whatsoever. Back in 2017, for instance, this bank had to be bailed out by the Italian government. However, as we are looking at it today, it is a different story. This bank surprised investors at the start of the year, announcing an offer for another Italian bank, Banca, an all-share deal of 13.3 billion euros. And so when I had the chance to speak to the CEO, Luigi Lovaglio, yesterday, I asked him if the ongoing market turbulence could actually derail his plans for Banca.
I think the situation will not impact on our deal. Is on the opposite, confirming that size matters. Is confirming that you need diversification of revenues. That in this situation, let's think that we are already a combined entity. We will be stronger. We will have higher capital. We will have capability to react much quicker. And everybody will think that from the strong position we would have all together, we can face much better also this adverse scenario. Is a confirmation that you cannot sleep on what you already have. It's wrong not to think, to change, especially when situation is better than normal, right? And this what interest rate was higher. I think at that time everybody should have done something in order to become stronger and also bigger.
I just have to go back to the point that this is an all-share deal. I'm struggling to understand how can you move forward given the pressure on banking shares at this stage.
I think what is important is the exchange ratio. No? The exchange ratio up to a few days ago was showing that practically our offer was fair. Now, clearly, day by day situation will change, but according to me, getting close to the deal, this exchange ratio will be confirmed.
And again, I just would like to get a clarification here as to whether you rule out perhaps adding a cash side to the offer.
At the current stage, I still believe that the price is fair.
So Luigi Lovaglio, they're adamant really that the offer they made for Banca was at the right price, and therefore not answering the question as to whether he's prepared to sweeten the deal for Banca shareholders. However, we also have to take a step back and look at this deal amid what's going on in Italian banking consolidation. This is not the only potential deal that's on the table. And Luigi Lovaglio believes that what we are witnessing right now is just the first phase of domestic consolidation, and that in 2 years' time there will be another phase in consolidation, and that time it will be about cross-border deals.
I was saying even 2 years ago, really size matters. We are a market that is still too fragmented. And it's not Italy, you think Europe. If you put together the 9 banks in European Union, the market cap, all of them, is lower than the one of the first American banks. And even if we had UK and Switzerland, the top 6 are lower than the first one in America. So it's size matter because you need really to keep investing, to have a transformation approach, and consolidation is needed. Consolidation is also necessary because you have to change in some way the approach to business. Mm-hmm. You need to enlarge the distribution. You need to enrich the offer. You need to open a new market. And you can do only if you have the right size. And also in terms of cross-border consolidation, first you should reach a certain position at home. So it's difficult that you can make cross-border. So that's why the size is important. And I think the process of consolidation in Italy started even late, according to what is my view. Mm-hmm. That's why we'll go ahead, and I believe this is the first phase, and probably we will have a second phase 2 years from now. That's why, by combining Monte Paschi with Banca, we will be in the position to be again a protagonist also on the second wave of consolidation.
So this is just a first step for you. You see even wider ambitions for Monte dei Paschi.
I think we will be really in one of the strongest positions on the market, having in mind the capital, the capability to make profit, a sustainable way, and overall I think it's quite important to underline the strength of our network and the capability to generate continuous capital for the benefit of the shareholders.
But for the time being, Luigi Lovaglio, the CEO of Monte dei Paschi di Siena, is focused on that first phase on the deal for Banca, which he believes he can complete by July.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.